economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 4.6% at the end of 2024, and 3.4% at the end of 2025.
That was U.S. Federal Reserve Chair Jerome Powell speaking at today's press conference on the U.S. Central Bank's projections. Let's bring in Jeffrey Lacker, former president and CEO of the Federal Reserve Bank of Richmond. He's also now a member of the Shadow Open Market Committee and an independent group of prominent economists. Thank you so much for joining us today, Jeffrey.
My pleasure, Jacqueline.
So what did you make of the decision that the Fed went with, the first pause after 10 meetings in a row of raising rates, but also the language and the message that it sent?
It was a bit puzzling. So coming into the meeting, the clear flow of the data was that it was stronger than expected. And so as expected, their projections marked up the expected growth rate of GDP. They marked down the expected unemployment rate at the end of the year, and they marked up their expectation for inflation, marked it up by 60 basis points. Having said that, they also marked up their funds rate projection as well. But on the other hand, they didn't move rates at this meeting. So it was a challenging sort of high wire act for the chairman to kind of explain why they didn't move when the outlook had changed in one direction.
Yeah. So, OK, so the pressure is on still at this point. I mean, it sounds like it's increasing, in fact, in terms of those expectations, whether it's inflation but also the lower growth as well next year, at least.
Mm-hmm. Right. So backed off a little bit next year. But the key thing is the next few months, the next few quarters. And coming into this meeting, their latest projection had been that they'd only maybe do one more hike. But now they're penciling in 2 rate hikes, and all but 2 members of the committee think they need at least one more hike before the year is over. And yet they didn't hike today. It was sort of a disjointed message he had to convey.
Do you think that they should have then?
I don't see why they'd wait. His explanation was that he distinguished between the pace of increases and the ultimate destination. So he's placing a lot of weight in the destination having moved up by 50 basis points and tried to downplay the change in the pace, meaning that they'd skip this meeting.
Yeah, I thought that the way one of the journalists sort of illustrated it, saying that, it's like wanting to lose weight by the end of the year and buying a gym pass, but not actually going to the gym and getting any work done.
Yeah, so the key problem for them is that they've raised the funds rate up to the level of current inflation. And so they really haven't tightened policy. The real interest rate, the inflation-adjusted interest rate, is still around 0. And that measure, the real interest rate, is what incents people to forego outlays today in favor of outlays tomorrow. That's what they need to incent in order to restrain inflation. They need to restrain current spending, and the way to do that is to raise the real interest rate. So while they've raised the inflation forecast for the end of the year by 60 basis points, they've only raised the Fed funds rate forecast by 50 basis points. So they're forecasting policy that's no more tight than it had been. And so puzzlingly, they're not really forecasting tighter policy in a real sense.
Yeah, that is really interesting. When it comes to the inflation situation, why do you think it is persisting in the way that it is, and that interest rates haven't had more of an impact at this point?
I think it's clearly because the Fed hasn't done enough. If you look at historical relationships between the federal funds rate and current inflation and current unemployment, in the past, in periods of time over which the Fed has been relatively successful at reducing and containing inflation, it indicates that the Fed funds rate should be over 7% right now. And that's not where the Fed is. And so it's, in some sense, things aren't slowing down because they haven't done enough to restrain current spending. And I think the strength you see on the real side, the strength in the labor market, and the persistence of core inflation, which really hasn't come down at all over the last 6 or 7 months, I think are all symptoms of that.
So how much of a risk is it, Jeffrey, that inflation gets stuck at this higher level if the Fed stays where it is right now, maybe continues to hike a little bit later this year, but like you said, doesn't get to that really restrictive place?
I think it could persist, and I think they could find themselves at the end of the year with inflation about where it is now. That would be my baseline forecast, in which case they'd have to face the challenge of telling markets, explaining to markets why they need to raise rates even higher. So I think we're going to see the expected path of the funds rate marked up over the next half year or a year. The sooner they do that, the better, but stretching it out just makes the pain worse.
Powell called the July meeting a live meeting. What are you expecting to see in July? I mean, it sounds like you'd like to see a hike. Do you think that they'll do that as soon as July?
Given what the committee said about where they expect rates to be at the end of the year, unless something very unusual and unexpected happens, I'd expect them to raise rates in July. But it was striking that he bent over backwards not to strongly signal a rate increase then. In fact, he accidentally used the word skip about this meeting, and then he corrected himself as if, the idea being that skip implies there's a rate increase coming at the next meeting.
Yeah.
And so he'd been forewarned or plans not to use that, and did so accidentally and then took it back. So it was kind of funny.